Investors are pouring billions of dollars into these rotation ETFs. And of the top 8 active ETFs that people have been buying this year, these are the only 2 we haven't covered. So, in this video, we're going to start with an overview of what rotation ETFs are and then dive deeper into THRO and DYNF to help you see what all the fuss is about and decide if they might make sense in your portfolio. Let's dive in. Rotation strategies are all basically versions of a form of top down investing that tries to adjust the portfolio to different areas based on market conditions. So think of it this way. At the ultimate passive side, you've got broad index funds that simply track a diversified index and don't make any changes. Think like VU, for example, or any other S&P 500 ETF. Then, still on the passive side, you've got sector or regional ETFs that take the same approach, but only within a specific area like Europe or industrial stocks or whatever. Those might allow you to take a bit more of an active approach, but with passive investments. Then you've got what I call quasi-active, term I made up. These are quantitatively run strategies that target specific types of exposure consistently, like DFA and advantage strategies that bias their portfolios toward value and small caps. Then, finally, on the full active end of the spectrum, you've got 2 broad approaches to active management, aka picking stocks or bonds to try to beat the benchmark or provide some sort of differentiated return pattern, maybe higher return, maybe a lower risk, maybe higher yield, et cetera, et cetera. One way to go fully active is probably what most people think of when they think of active management, which is a portfolio manager or a team of portfolio managers picking stocks or bonds within a certain region or type of company. But the other type is top-down active. That's not so much picking individual stocks, but investing from a macro perspective and rotating between groups of stocks based on themes, maybe interest rates or the strength of the economy, factors, which we'll get to in a moment, or many other possible high level or what's called top down angles. So let's start with THRO, the iShares US Thematic Rotation Active ETF, which has absolutely crushed the S&P and its competition since its inception in December 2021. They use AI tools to choose which themes to invest in and rotate across those themes based on quantitative signals within the constraints that it's meant to be a core equity position, i.e., it's probably not going to invest every dollar into some risky, unproven theme all at once. With results like that, ahead of the S&P by almost 4% per year since inception, this one is definitely worth looking further into. THRO targets a combination of long-term structural negaforces like AI, more medium-term macro dynamics like where they think we are in the market cycle at the moment, coming out of a recession. Maybe it'll buy more cyclicals, for example. That would typically do well in a recovery, that kind of thing. And finally, it invests in more short-term emerging themes, which they don't really give us much detail about, but I'm guessing it might be taking advantage of some sort of short-term market dislocation that they think will correct itself in relatively short order. If I could sum up this part in black, they basically comb the internet using AI to come up with what themes to invest in, which in my opinion is super freaking cool. What's interesting are these yellow and blue boxes at the bottom. The green one makes sense, right? Favorite themes with good valuations and resilient businesses. Translation, high-quality companies at a reasonable price. Yeah, of course. This is not too different from the kinds of factors that companies like DFA or Avantis would focus on. However, the yellow box sounds a lot like the momentum factor. They favor themes with positive investor sentiment and price trends. But then the blue one says that they favor themes with relatively lower risk of overcrowding. Now, I find this interesting because a key feature of momentum strategies is that they tend to buy whatever is popular and thus is most subject to overcrowding, like when everybody and their mom is buying NVIDIA, for example. So maybe they're trying to get in early and not overstay their welcome or limit that risk in some way. Right now, some of the major themes that are represented in the portfolio are preference for companies that can benefit from modest interest rate cuts, the rebuilding of the US physical economy, and the continuation of the AI infrastructure buildout. And from a sector perspective, it kind of just looks a lot like tech, which I guess isn't surprising if we're thinking about momentum plus companies that can benefit from the build out of AI infrastructure and so forth and so on. This isn't that differentiated from the NASDAQ at the moment. And you can see its results have been almost identical to QQQ since its inception. But it did hold up much better in 2022 with THRO in blue and QQQ in red. Then it trailed QQQ in the recovery of 2023, beat it as tech rallied continued in 2024, and it trailed it again more recently. So you can see the thematic rotation at work. Sometimes it works better than others, which is, of course, what you should expect from basically any strategy. This one is just probably a little less predictable when it will work and when it won't. So, would I invest in this? Well, I'm not actually planning to, but I wouldn't discourage anybody else from doing it. In theory, rotating based on themes makes a lot of sense. Like, why wouldn't you focus on the area of the market that are going to be more in favor? The answer is there's really no reason not to, other than the fact that historically, finding consistent long term success with these strategies has been a lot easier said than done. That's why you haven't heard of a lot of them because they usually don't work. This one is relatively untested and it has an expense ratio of 60 basis points or 0.6% to invest in it, which in my opinion is a little high for a strategy that's run by AI basically. That said, the AI aspect of it does make it interesting to me, and I'm sure we'll see more of this over the coming years. Definitely be skeptical when you see those ads that say things like, our AI turned $5,000 into $1 million in 3 months, pay us for access. You can easily run 1,000 different models. Inevitably, one will work over the 3 months, and then top that one. Those things are a major red flag. But this strategy started in 2021, years before the AI hype. So, as a complement to more passive core exposure, or if you just want to take a chance on it, I don't think there's anything wrong with investing in THRO as a core US equity option or as a complement to one. That brings us to DYNF, another rotation ETF from iShares that has a ridiculously strong track record over the last 1, 3, and 5 years, as you can see down on the bottom right. But before we dive into that one thing that continues to baffle me is that 74% of you that watch this channel regularly have not yet subscribed to it. So, could I ask you for a favor before we continue? If you like this channel and you're getting value out of it, you want to support us, the free and easy way to do that that would have a massive impact on our lives and cost you nothing is by simply hitting that subscribe button. And my commitment to you is that if you do that, my partner Kyle and I will continue to do everything in our power to help you become a better investor. Thank you so much. Okay, back to DYNF. A lot of what's on this page, honestly, is fluff, but I'll point you to the pink section. This basically is designed to beat the US market and serves the same role in a portfolio that THRO does. But instead of themes, this one rotates based on factors. Factors are basically characteristics of companies that have historically been shown to produce better risk-adjusted returns than their counterparts. So, like value has historically done better than growth. Low volatility has historically done better than high volatility, and so forth and so on a risk-adjusted basis. That's important. So these are the factors that DYNF rotates between, and they decide what to rotate to and when based on the colorful boxes and the economic cycle chart at the bottom. So, for example, low size is what they call alpha seeking. Low size is code for small caps, basically. And of course, small caps tend to do well in the recovery phase after a market downturn. Momentum, which we talked about earlier, is more quantitative and data driven. And min-vol, aka lower volatility stocks, obviously do better in economic slowdowns or recessions. Conceptually, this is super obvious, right? Oh, you'd want to invest in more aggressive stocks during the market recovery and more conservative ones as the market is falling? Duh. The challenge is it's hard to predict when those things are happening with any regularity. And they kind of haven't. Yes, if you look at their 1, 3, and 5-year returns, they look great. That benchmark is actually the MSCI USA, not the S&P 500, but pretty close to the same thing. They've dominated it over all the commonly looked at time periods, but they've only beaten it by 33 basis points per year since inception. Still ahead, but it begs the question, what happened before the last 5-year period? The answer is they actually trailed the benchmark in their first 3 calendar years, including by a pretty significant amount in 2020. Then, in 2023 and 2024, they crushed it. I think this is probably a relatively reasonable return pattern that you can expect from a strategy like this. It will likely deviate pretty far from the benchmark pretty regularly, sometimes in a good way, other times not. So, would I invest in this one? Probably not. This is more like a traditional rotation ETF that has been hard to find success with in the long run. I think we've been on a great run here, and while that doesn't technically mean anything for what's about to come, I expect to have a lot of really good years and a lot of really bad years. So, all else equal, I wouldn't be personally inclined to chase it after 2 good years. Just not my style. But there's nothing inherently wrong with this strategy. Well, unless you're the kind of investor that would give it a shot, and then sell it if it started doing poorly. I think those periods will be inevitable, even if the long-term results turn out to be really good. So if you're just going to sell it as soon as it goes out of favor, you're more likely to lock in poor returns, and maybe you shouldn't be investing in this kind of a strategy. In my opinion, there's nothing wrong with investing in this, but I'd only do it if I really believed in its approach and wanted to ride its ups and downs for the long haul. At 27 basis points or a 0.27% expense ratio, it's more reasonably priced than THRO, but I think if I had to pick one, it would probably be THRO, just because of the simple appeal of AI being relatively untested in the world of stock picking, at least outside of the hedge fund world, and them having a pretty decent track record at it so far. If you found this video helpful, hit that like button and let us know, and then leave a comment with what you'd like us to cover next, and of course, subscribe so you won't miss it. Thank you for watching, and we'll look forward to seeing you in the next one.